Hello guys, and welcome to the channel. If you've ever wondered how to build true, lasting wealth that isn't tied to your work hours, then you're in the right place. Today, we're breaking down one of the strongest tools available, rental property investing. We're going to simplify the idea of cash flow and make it so simple and easy that by the end of this video, you will be able to understand how people use real estate to gain financial freedom. This has nothing to do with get-rich-quick schemes. It has to do with a proven means to create a sound financial future. So, let us begin. So why rental real estate? Essentially, it's three. For starters, you gain financial independence. A solid rental property generates a consistent monthly cash flow that covers its own costs, the mortgage, the taxes, the maintenance, without your having to dig into your own wallet. That leftover money is what we call cash flow, and it's the lifeblood of this system. Second, that surplus gives you the power to expand your portfolio. Instead of just wasting that money, you can invest it in a second house, then a third, leapfrogging your growth in a fashion it's hard to do with other investments. And finally, it leads to the ultimate fantasy for most of us, early retirement. By building these sustainable income streams, you're building a future where your lifestyle is funded not by a paycheck, but by the assets you've built. That's true financial freedom. And now the secret to winning this game is no secret. It simply boils down to three golden rules that sound ridiculously easy, but are actually very potent. First, and you've heard this a million times for a reason, location is key. It's not just about a nice-looking street. Smart investors look for established areas, or even better, emerging neighborhoods with planned infrastructure, like new schools or transit lines that are going to drive property values up. Adopt a buy and hold philosophy. That's the opposite of flipping. It's not flipping, it's patience. You go along with compound growth where a property doubles or triples in 10 years. It's a marathon, not a sprint. And third, and not negotiable, target positive cash flow. You have to buy properties where the rental income will always be higher than all the costs. We're talking about properties that will give you a 6 to 8% rental return. That positive flow is your insurance policy and your engine of growth in one. These three rules are synergistic as a great system. Now, the moment you begin going into details, investors tend to move towards one of two broad strategies, and it's necessary to know the difference. One is the cash flow strategy. This is all about that consistent, reliable monthly cash flow. It's perfect if you're looking for predictable money to spend or invest immediately. It's like building a consistent engine that just generates cash. The other path is the appreciation strategy. Here, you're primarily banking on the property's value increasing over time due to economic growth or development in the area. This can have higher potential returns, but it's also riskier because it depends heavily on market conditions. If the market dips, your profits can too. Many successful investors combine the two methods. They invest for income in a market with good appreciation potential as well. That way, you enjoy the best of both worlds, income today and wealth formation tomorrow. Alright, now let's get into the most important part, the math. And don't worry, it's simple. The basic equation for everything that we're talking about is this. Cash flow equals total income, total expenses. That's it. Your net income is all except the rent, but as we shall discover, sometimes it is more. Your total cost is all of it. Mortgage, taxes, insurance, maintenance, you name it. If the number is positive, you are making money each month. If it's negative, you are subsidizing the property out of your own pocket, and that is something you do not want to do. This calculation is your initial and most essential test for any property. Let's make that formula real with an example. Imagine two identical properties, each renting for $2,500 a month. In the positive cash flow scenario, let's say your mortgage is $1,000, and all your other expenses, taxes, insurance, fees, and a reserve for vacancies add up to $800. So total expenses are $1,800. You're left with a healthy plus $700 in your pocket every single month. But in the negative cash flow scenario, maybe you borrowed another loan and your mortgage is larger, say $1,400. Now, your overall bill is $2,200. Though the rent hasn't changed, now you owe a negative $300 difference. This simple chart demonstrates why the details of your financing and expense estimates are so vital. And here's a pro tip that will really drive your profits to the next level. Ancillary income. This is the income that you make above and beyond the base rent. It can add 4 to 5% to your overall top line and is an excellent way to drive income without raising the rent itself. Look at bulk internet packages. You set it up with an ISP and pass it along to tenants. In a 200-unit property, this can mean an extra $6,000 per month. And then there's pet rent. With all the renters who have pets, it's easy to charge a setup fee and a small monthly rent per pet, which can add up quickly. Don't forget premium parking, especially in cities. You can charge anywhere from $30 to $100 for a reserved parking spot. And storage rentals? $50 a month for a locker? If you've got 30 units, that's $18,000 a year in virtual pure profit. These small streams create a huge financial cushion. One of the largest pitfalls of new investors is the underestimation of expenses. You must understand there are two broad categories of cost. Then, operating expenses, or OPEX. These are your day-to-day expenses to run the property. Regular upkeep, management fees, insurance, and taxes. The good news is, these are all tax-deductible every year. Then there are capital expenditures, or CapEx. These are the big occasional costs that improve the property in the long run, like a new roof or full HVAC system replacement. You don't get to deduct them all at once, but you depreciate them over a span of years. CapEx planning separates amateurs from experts, because if you don't, a $15,000 roof replacement can ruin your finances. Before you even reach the hardcore analysis, you need shortcuts to screen out lousy deals. That's where rules of thumb come in handy. The 1% rule states that your rent should be at least 1% of the whole purchase price. Therefore, a $300,000 home should get you $3,000 per month in rent. It's an initial shortcut filter. 50% rule is an estimate of costs. It says about half your gross rent will go towards operating costs, excluding the mortgage. So on that $3,000 rent, you'd estimate $1,500 for costs, leaving the rest to cover the mortgage and hopefully leave you with cash flow. Now, a huge caveat. These are screening tools only. They're not perfect, but they help you make the preliminary decision of whether or not a property is even worth further analysis. Once a property has been screened, you need more detailed metrics. The big three are cap rate, ROI, and cash-on-cash return. The cap rate, capitalization rate, tells you about the possible income of the property versus cost. It is usually 5 to 10%, depending on risk and market. ROI, return on investment, is your net profitability. But I prefer cash-on-cash return. This informs you of your annual cash return on the actual cash you've contributed yourself. If you've contributed $40,000 and the property pays you $8,000 annually in cash, your cash-on-cash return is a whopping 20%. This indicator reveals to you the real magic of having leverage when investing in real estate. How you pay for the property is a strategic choice. Your two main options are traditional mortgages, which are great for long-term buy and hold. They have good interest rates, but usually require a 15 to 25% down payment. Hard money loans are short-term, expensive, but fast. They're great for fix and flip guys who need to act quickly and don't care to hold on to the property for a long time. And then there's creative financing, like seller financing, where the seller acts as the bank. This can be great on deals where traditional lending is not possible. Your financing must always align with your investment strategy. If you only look on the MLS, you're bidding against everyone. To find real deals, you need to get off-market properties. You can go driving for dollars. Literally drive around looking for vacant or run-down houses. They might be owners who'd be eager to sell quickly and cheaply. Networking is huge. Make friends with agents and other investors. They might have leads on deals already before they're on the market. And you can search for foreclosures and tax delinquencies in public records. Those are gold mines to locate sellers who have to sell right away. That's how you find diamonds in the rough. A big decision is what type of property to buy. Let's look at single-family and multifamily. Single-family homes are a reasonable place to start. They're simpler to manage and easier to lend against. But the big risk is vacancy. If your only tenant moves out, you've got a 100% loss of income. Multifamily homes, like apartment buildings or duplexes, are more complex and require a greater down payment. But the huge advantage is diversification. If one of them is vacant, the others are paying the bills. They offer more stable cash flow and scale much more effectively. The second key choice is the rental period. Long-term rentals, 12-month leases, are the old way. They give you stable, predictable cash with less headache management. Your operating expenses are around 35% of revenues. It's more passive and safe. Short-term rentals, like Airbnbs, can bring in 2 to 3 times the revenue, but they're work. Expenses are greater, around 50%, and you're dealing with steady turnover, cleaning, and marketing. They're also getting hit with more regulations. It's a high-reward, high-effort play. Properties are usually graded A, B, C, or D, and this will tell you a great deal about risk and reward. Class A is newer, in prime locations, low risk, but costly with lower returns. Class B is older but well-maintained, with a good mix of risk and reward. This is where most investors begin. Class C is old, needs rehab, and in lesser quality neighborhoods. Higher risk, though also higher upside potential through value-add improvements. Class D is the riskiest, terrible condition, high crime neighborhoods. It's high risk, high reward, and not for beginners. Your choice here establishes your entire experience as an investor. Yes, real estate does involve risks, but you can minimize them. Market risk. Don't over-leverage yourself. Have cash reserves so that a slump won't force you to sell. Location risk. Do your research. Research the area, visit at various times, review school ratings. Legislative risk. Stay informed about local legislation, including rent control. Diversifying throughout different cities can reduce exposure. Property risk? This is simple. Always, always get a professional inspection. It's the best few $100s you'll ever spend. Besides the property itself, you need to protect you. Form an LLC to separate your own money from your business money. In case anything goes wrong with the property, your own house and savings are secure. Get specialized landlord insurance. A typical homeowner's policy will not suffice for rental use, and always have cash reserves on hand for the unforeseen. A busted water heater or 2 months' worth of vacancy shouldn't be a financial crisis. Your tenants are going to either break or make your investment. It starts with thorough screening. Check credit, income, and rental history. Great tenants are worth their weight in gold. Have clean lease agreements with no room for interpretation, and demonstrate proactive communication. Respond quickly to maintenance requests. Happy tenants stay longer and take better care of your property, saving you money in the long run. So to just summarize the key numbers you must remember, shoot for 6 to 8% rental yield. Remember the 50% rule as a quick estimate of costs, and the 1% rule as a quick test of income to price. These are your guiding stars on how to search for profitable deals. There you go. Investing in rental property is not rocket science. It is simply a matter of grasping the fundamentals: location, long view, and profitable cash flow. It is about working the transactions cautiously, hedging against risk, and expanding strategically. This is a journey that requires discipline, but one of the most proven paths to financial freedom. You're not buying a property, you're building a system that generates income on your behalf. If you found the video helpful, please like it and subscribe for more simple explanations of wealth creation. Thanks for watching, and I'll see you in the next one. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.